Welcome everyone to this video on currencies. In this video I'll be explaining what currency pairs are and explaining four types of currency pairs. Yeah, let's get started. So when we say currency pairs, what we refer to is when two currencies are traded against each other. So we could be referring to when the euro is traded against the US dollar, that's a currency pair. The pound against the Canadian dollar, that's another currency pair. And I will be explaining the four types of currency pairs. And the first one are called major currency pairs. The second are called commodity currency pairs. The third are called cross currency pairs, and the fourth are called exotic currency pairs. Yeah, let's get started. When we talk about major pairs, what we refer to are the Euro USD, which is the most liquid and the most volatile currency pair on the Forex market and the most traded on the Forex market. Then we have the USD and Japanese yen, the pound and the USD, and the USD and the Swiss francs. And these are the symbols for them. And when we say these are the major pairs, what we mean is that these currency pairs are the most liquid on the Forex market. They are the most traded on the Forex market, and they are the cheapest to open and close positions. So these are ideal for traders who want to conduct two free trades every day. Very ideal. Now let's move on to commodity currency pairs. As from the name, you can probably understand that the currencies I'm going to be explaining now, they correlate with their commodities. And these are the USD and Canadian dollar, Australian dollar and USD, New Zealand dollar and the American dollar. And these are the symbols for them. So yeah, let's start with Canada. Now Canada have the third largest petroleum reserves on the planet, and they are the fourth largest exporter for petroleum and natural gas. So evidently their commodities correlate with the Canadian dollar. So their oil industry affects the Canadian dollar quite a lot. And moving on to the Australian dollar, which is affected by the mining industry of Australia, because Australia have a very large proportion of their GDP comes from the primary sector and the mining industry of coal and iron ore. So in that respect, they are also affected by their commodities. Now, the New Zealand dollar is also, and they're mainly involved in like aluminium production, mining, and food processing. I think the main one is their food industry is the most important for them. And yeah, so I just briefly explained why they're called commodity pairs. And I would like to say that some people would combine the major pairs and commodity pairs into one large group called major pairs. The reason why I split these up is because sometimes you hear people say commodity pairs and you understand the pairs that they're talking about. But really, these two groups should be put together into a major pair. These are equally as liquid and could yield great opportunities for whoever wants to trade these currency pairs. And for example, the Australian dollar and the Canadian dollar, they are both more traded than the Swiss francs in general. So I only split these so then you can understand when people say commodity pairs. Yeah, so let's move on to cross currency pairs. So the cross currency pairs are you know the two groups that I explained before? Well, remove the USD, and what you have is a list of a mixture of the currency pairs. So, for example, you'd have the euro and the pound, the euro and Australian dollar, the pound and the Japanese yen, the Swiss francs and the Japanese yen, the New Zealand dollar and the Japanese yen, and the pound and the Canadian dollar. So none of these have the US dollar involved in them, but they also yield they could yield great profits from them, and they are also quite liquid as well. And the last group is called are called exotic currency pairs. Now these currency pairs, um, they're thinly traded. They're not traded as much as the other pairs. Maybe like um, some of these currency pairs, and these currencies are traded like 2% out of the total volume of forex trading. So these are the euro and the Turkish lira, the USD and the Hong Kong dollar, the Japanese yen and the Norwegian krona, the New Zealand dollar and the Singapore dollar, the pound and the South African rand, and the Australian dollar and the Mexican peso. So, so like I said before, these are thinly traded. There's less ease in trading them. Um, it's much more costly to open and close positions for these currency pairs as opposed to the major currency pairs. And these trading opportunities are more for swing traders. So those traders who want to trade long term, maybe for weeks, days, weeks. It's a good opportunity maybe for those traders. But for a beginner, I would not advise for beginner traders to look at this list at the moment. And yeah, so thank you for watching this lecture. In the next lecture, I'll be explaining um, four major currencies, which are the first one is the US dollar. Then I'll be explaining the euro, then the Japanese yen, and then the British pound. So I look forward to seeing you in the next video.